Before I start, I suppose I should mention that as head of impaired annuities for SCORE in the UK, I perhaps haven't got an entirely impartial view of the changes I'm about to describe. So this market, or impaired annuities, individual annuities started in the UK around 30 years ago, when the UK government of the time decided they wanted to encourage people to save individually for their pensions, so they gave tax breaks. The key tax break was that if you put money into the cumulative phase of just to save while you're working, then you got your income tax back. So broadly speaking, that's what's happened for 30 years. People have been contributing, saving money, and they get the income tax on those savings. And so there's a big tax incentive to save for an individual pension. At the other end of the equation, when you stop accumulating and retire, there was a strong tax incentive to buy an annuity. And so for 30 years, you've had this relatively simple scenario where people who want to can take advantage of the tax incentives, and then when they retire, they buy an annuity. And that's broadly been the picture for about 30 years. So a couple of things have happened over those 30 years. We've been talking quite a lot about how life expectancy has increased for anyone older than 65. The other thing that has happened is, more recently perhaps, is that investment yields have really plummeted. And that means that annuities, people have started to look at annuities, and annuity rates have gone down and down and down, more or less uniformly over the last 30 years, and they just look like poor value. So this is what the media thinks of annuities. This is before the announcement of the change. And I think maybe one other thing, apart from the investment yields and the changes in longevity, one thing that really made people think in the UK market was that if you went to one annuity provider and then went to another and then went to another and shopped around a bit, quite often one would give you an annuity 20% higher than the next one. So this is, if you're someone who doesn't understand all this stuff, maybe someone who doesn't understand all this sort of stuff, you look at that and you think this just looks like a rip-off. And that is pretty much the public view of annuities in the UK. So surprise, surprise, the last sentence, more or less, of George Osborne, the UK Chancellor of the Exchequer, the last sentence of his budget speech in March 2014 was, "Let me be clear, you won't have to buy an annuity." Incredibly politically popular. But there's obviously more rationale and more argument to have, and I'll investigate that during this talk. But that was, at the time, it was a big shock. I say surprise, surprise, but that was a big shock. I don't think anybody saw it coming. And it was a very big surprise to everyone in the industry. So in this talk, I'll talk about the market before pension freedom, so you understand a bit more about that. Then talk a little bit about the change itself, and then the initial outcome, and then future prospects. I suppose any sort of comment about future prospects comes with a large health warning in that we can only speculate, because it's early days yet. It will take years before the market sort of normalizes, if you like, and we're sure what the consequences of that change are. So before pension freedom, this is what how the market had developed. So it started in around 1985 that people could start to save into this market. So not surprisingly, the annuity values, which is after saving it, you get to retirement and then use your money to buy an annuity, the single premiums have been growing steadily. So the first comment on this is it was a steadily growing market and quite dramatic growth. If you look over the 10 or so years there, the market's doubled. And certainly looking back at 2013, there was no reason to think that it wouldn't just continue to grow in that way. The second thing I'll bring to your attention here is the increase in enhanced annuities. So standard annuities are priced, or were priced at the time, only on gender and age. So you had a big market which was priced where someone bought an annuity and it was priced only on gender and age. And then over time, we started doing some medical underwriting, and you get these enhanced annuities, and they really took off from about 2005. So you can see in the figure there that whilst the whole market has less than doubled since 2005, the enhanced annuity market has gone up, fourfold or something. So this is the picture that you had before the announcement. just a little bit more about enhanced annuities. So until 1995, pretty much all annuities were just rated by age and gender. And so that was quite a cosy place for the annuity providers to be. But some sort of new players started coming to the market around that time. And this is how we get into this sort of enhanced annuity situation, where you imagine if you offer the same annuity to these two chaps, you can guess that the one on the right is going to be quite profitable, and the one on the left you might make a loss on. So an enhanced annuity provider can do a little bit of medical underwriting, offer a higher annuity to the person on the right, and still make more money. And that leaves the standard annuity provider losing money by writing only the very fit people. So you start off saying, oh, as long as I can establish that someone's had cancer or just is very overweight, and it's relatively simple. But after about 10 years of writing enhanced annuities, it's getting more and more complex, and people are underwriting for all kinds of impairments. So just one more word on this, partly as a sort of defense to that, the standard annuity providers started rating by postcode. So postcode is an area which covers, let's say, 10 households in the UK, something like that. And the insurers and others have found, as we've discussed at this conference in quite great length, that postcode is related to socioeconomic group is related to mortality. So that even without doing any medical underwriting, you get the postcode and someone's address, and you can actually give quite a significant rating. So the bar I've added on the end there, which is low seg, is based on postcode. And if you have two extreme postcodes, one at the very sort of very long-lived end and one at the very short-lived end, you can get quite a serious uplift just by rating on postcode without any medical underwriting. So that's what was kind of going on in the market before the changes. One other angle I'll let you consider before I go on to the changes is from the perspective of, this is a deliberately complicated and probably not quite technically sort of accurate diagram. The point I'm trying to make is, if you imagine you're not in the insurance industry or the finance industry, and you're not doing sort of academic research in those into longevity and so on, you don't really understand what a pension is, you don't know what an annuity is. What happens is, if you start on the top left of that diagram, the first thing you know about all this sort of stuff, about annuities and funding for your retirement, is you get a letter from your provider telling you that you have, let's say, £20,000 in your pension pot, and you get about pages and pages of quite complicated stuff, concepts you've never really thought about that you don't really understand. And at the end of it, or somewhere within there, you get an option of saying, if you just sign on this line, we'll give you an annuity of this much, which will give you a regular payment for the rest of your life. So you have the option of signing on a dotted line and taking your regular annuity, or you can try and get your head around all this stuff. And one of the problems in the UK, which I'm sure happens elsewhere as well, is just inertia. People aren't interested, and they can sign on the dotted line, get whatever annuity they're offered, and then they can go back to doing the washing up or arguing with their wife or whatever it is they like to do. So the regulatory authorities in the UK were very much aware of this. So they spent, one of the reasons for the growth in enhanced annuities that I've just shown you is that they were really encouraging people to shop around. So they were enforcing insurers to write, when they write to someone who is coming to retirement, they force them to say, you can shop around, you ought to shop around, go and see an IFA, an advisor, and so on. And so by 2012, those figures on the right-hand side show you where things had got to. So the top, these are ABI figures that are available from the ABI. So top right, these are internal standard annuities. So about 40% of the market was people who were simply buying the annuity they were offered by the company they had been saving with. External annuities come from shopping around, and let's say 60% of people were shopping around, and of those, about half had a standard annuity because they're healthy, or at least it wasn't spotted that they weren't healthy, and the other half had enhanced annuities, which meant that they had some sort of medical impairment, which meant they could have a bigger annuity. So the authorities were quite worried about that stuff that's top right, and were thinking that people who just brought an annuity without shopping around may not be getting the best deal. And this is a much better, improved position compared to where we were in 2005 or 2000. So the change, I'll just give a quick technical view of the change, just to confirm. So it was true before and after the change that 25% of savings can be taken as tax-free cash. The big change is what I've highlighted in yellow there, that whereas before, if you took cash instead of buying an annuity, you had to pay 55% tax. Going forward, you're just taxed at your marginal rate, which is normally a lot lower than 55%. So there's no tax disincentive for taking cash, subject to you don't want to take so much cash that you increase your marginal tax rate and so on. So there are a few complications, but essentially people are not penalised for taking cash going forward. One other thing I should mention, at the bottom there, defined benefit schemes. Thus far, the legislation is such that we don't really expect it to massively change defined benefit scheme business. So much of the business that's growing in the market, particularly for longevity swaps, is originated from defined benefit employer-sponsored schemes. So we wouldn't expect it to affect that market. Just a few words on the rationale for the change. Essentially, there's great political capital from the reasons I've just said earlier, because they are so unpopular. Secondly, it actually subtly sort of accelerates tax receipts for the government. So your current chancellor, insofar as people take cash, the current chancellor make his books look better. Future chancellors in 10 and 20 years' time might suffer a little bit, but that's sort of politically not his problem, if you like. So there's a significant amount of political capital in this move. And to be fair, it's in keeping with the Conservative philosophy that people should be allowed to do what they want with their own money. Finally, and perhaps most importantly, there is a good argument for encouraging, if the greater freedom encourages people to save more in the first place, then you'll get more people actually reaching retirement with enough money. The point being that many people don't have enough money at retirement now. So if you don't have enough money when you retire, it doesn't matter what you do with it, you haven't got enough money. So even if you think that buying annuity, that it was better to force people to buy annuities, if you like, it may be better not to force people if it means they save more and have more money when they retire. Oops. I'll skip guidance and advice because I think I'm going to run short of time. So, initial outcome then. So this is basically annuity sales. So the first three lowest bars there, or the four lowest bars, one of which is virtually negligible, are annuities, and then the top bar across that chart is drawdown, which is the alternative to buying annuities. If you don't buy an annuity, one of the alternatives is to buy a drawdown product from an insurer. So you can see that immediately the announcement was made in Q1 2014, business volume started to change. So for annuities, the business volume has gone down by about 60% since then, and it appears to be stabilising. The next couple of months after Q1 2015 are suggesting that it's stabilising, but of course it's early days yet, at around 40% of what the annuity sales were before the change. Drawdown has increased quite a lot, which maybe doubled over the period, but nowhere near enough to make up for the shortfall in annuities. So you can kind of intuitively think the gap between the sales in Q4 2013 and Q1 2015 is either going as cash, or maybe people are delaying making their decision. Now it's a lot more complicated. There's a fair chance that people are delaying and maybe even seeking advice, you never know. One other point I draw on here is I talked about the government encouraging OMOs, or open market options, in other words, encouraging people to shop around, and in particular being because they're concerned about, if you like, the internal standard annuities where people buy an annuity with the existing provider. Well, that's the one part of the annuity sales that hasn't shrunk so much. So I would imagine the government and the regulatory authorities still ought to be concerned about that. So apart from premium volumes, what else has changed? Well, quite frankly, not much really. So everyone's talked a lot about products and advice. It still seems that on a sort of global grand scale, there haven't been many new products produced. And I think that's for two reasons. One is it was only announced a year in advance. It's quite a big change. So insurers have been scrabbling just to meet the compliance requirements, never mind actually developing new products. So they've really, insurers generally speaking are sort of talking, well, that's just day one and there'll be more change to come. So there's a lot of talk about new products, but not much being put in the market yet. One thing I do mention guidance here, that as part of one of the concerns that were expressed at the time of the budget was that people were being suddenly asked to make a complex decision and didn't understand annuities and so on. So the government had this idea of giving free guidance, which they're doing. And there's more to talk about there, but for this purpose of this talk, I'll just point out that not many people seem to be taking it up. So the initial feedback we had was that there were 18,000 people who sought free advice in the first 10 weeks, and that's compared to 74,000 annuities in Q1 2014. Now those aren't quite comparable. You have to convert 10 weeks to Q1. I'll leave you to do that. But nonetheless, you can't get to something that suggests that everyone's taking free advice, which seems an obvious thing for people to do. If it's free, why not take it? So future prospects, as I said, it's early days yet, and there's lots of change to come, but I kind of like to take this sort of view of it. So if you like, the pensioner in the middle is the source of the demand, and the products around the outside. Not all of them are products in a sense, but they're the things you might do to use your cash that you have at retirement to pay for your retirement. So if you consider the pensioner box first, what is going to happen is, I think most people agree that the government are still trying to encourage more and more savings so that people have enough money at retirement. And so most commentators are suggesting that the at-retirement funds are going to grow by about 15% a year for the foreseeable future. So what's arriving at retirement is growing. Open question as to how much of that goes to annuities or anywhere else. There's a possibility of a DB to DC switch, which is, by them, I'm talking about people taking their employed sponsored benefits and transferring to DC just so that they can make use of these freedoms. But our current understanding is that isn't happening that much. Certainly not enough to affect the 2 trillion in the DB schemes that I talked about earlier. And then you've got the different products that we thought might be produced, very quickly, but haven't so much yet. Top left, I've got cash. Well, that's not really a product in a sense. They just take the cash and do what they will with it. Of course, to the extent people take cash, they might be investing it in quite sensible things, but outside the pensions wrapper. So it's not always a bad thing necessarily. The life annuity is what we've been selling. That's bottom right. And then the two sort of others on the right, drawdown on top right. Drawdown is what quite a few people have diverted to. I showed you the chart earlier with some drawdown being taken. And then I've put a sort of box on guarantees, contingent payouts. There's lots of conversation. I'm sure there will be more products in the future which will sort of give people the option of either of people who otherwise might have bought a life annuity might want to retain some of the longevity and investment risk. So you can imagine tweaking annuities to allow people to retain some of the risk. On the other side of the table, you can imagine people who are going to draw down and retain all the longevity and investment risk might have an appetite for some sort of longevity and investment cover that falls well short of annuity, but just as guarantees, similar to the products they have in the United States that they have attached to their annuity products. Hasn't really happened. There are products out there, but they're not really selling, to my mind, to the extent that they're really changing the whole market as in the sort of the global picture of the market. The other two things that are bottom left here are two different products, which are sort of sleeping giants, really. So equity release, you can see that people might run out of cash more than they used to in the past. So maybe this gives a bit of a fillip in the long term to equity release. So you have your lump of cash when you retire, you spend it, and then your asset that you have left is your house, and so you need to release equity from your house to pay for your retirement in older ages. You can see that happening more. The other item is long-term care. I know Stefan asked about it, so I'll answer his question now. So long-term care, I can see a change in the long-term care market, or at least a driver for change, in that people who now have a lump of cash at the age of 65 or when they retire, they now actually at least have the option of either keeping it and still having a lump of cash when they're older, when they need long-term care, or even buying some sort of long-term care policy, whereas before they didn't even have that option. So at least they're presented with a lump of cash and potentially some advice and guidance which suggests maybe they should take long-term care. The only sort of issue with that is that in the 1990s in the UK, a few insurers and reinsurers realised that there ought to be a big demand for long-term care because lots of people are going to need it. And they tried very hard. They developed products, they marketed them, they were reinsured, they were sold by insurers, and subject to a few that maybe are still open to business, it failed essentially. So there is some sort of long-term care market, but it's tiny. And, you know, fundamentally, I don't see how that's changed. There's a slow change in that more people are seeing their parents and so on going to long-term care, and more people are needing long-term care. But there's still quite a few barriers in the UK, I think, to long-term care becoming a really big product. So I'll leave that summary up there. I've just written, I think the only one thing I'd perhaps draw your attention to, which I haven't mentioned yet, is the bottom one, which maybe is particularly of interest to this audience, that I think if you want to ensure longevity risk in the future in the UK, you need to be underwriting probably on medical status, but also on postcode together. Thank you.
Thank you. So can you talk about whether the rumors of a traded annuity market will gain any traction, and whether people who have previously used their pension pots to buy annuities, is there any prospect of them being able to sell them, and what is the industry doing to prepare for that?
So we don't know the answer to that. The government has certainly seems to be very keen on it at the moment, but there is a review ongoing. Maybe Phil can add to my comment, but from my understanding, there's a review ongoing and a consultation, a white paper, and they're taking responses. But the feeling is that it's very much viewed positively by the current government, and therefore will happen. And from an insurer's perspective, there's a key thing which again is undecided, that's been raised as a question, which is when someone sells their annuity, can they sell it back to the original insurer? And so does it extinguish the original liability? Because if originally the talk was of a secondary market where, a bit like I think the way the life settlements market works in the US, where you sell your annuity, but your insurer still has a liability to pay your annuity until you die, and then the payments just get you assign the payment to somebody else. So if that happens, then it's unlikely to have such an effect on insurers. Some insurers might play in that market as an asset, which is quite a useful thing because it matches longevity risk quite well. I think it's more complicated if the legislation goes another way and is even more flexible.